Hey everyone, welcome back to Corporate Decoder, the place where we try to unravel the hidden stories within these financial filings. And today we have Chainbridge Bancorp Incorporated's quarterly report, which might just tell us if their bridge to better banking is built on solid ground or a bit shaky. This bank holding company's latest report shows some interesting shifts in their financials and strategy, especially with their unique client base of political organizations. Let's dive into what this actually means for the company's financial health. We need to understand how their stock structure, with Class A and Class B shares, plays into their overall performance. It is not just about how much money they made, but how that money is divided and valued. Looking at the balance sheet, Chainbridge Bancorp's total assets reached $1.5 billion by the end of September 2025. That is up from $1.4 billion at the end of 2024. Their deposits also saw a healthy jump, going from $1.2 billion to $1.4 billion. This growth is a good sign, hinting at increased trust from their clients. Now let's talk about their cash pile. They had $395 million in cash and cash equivalents at the end of September 2025. That might sound like a lot, but it's actually a slight decrease from the previous year. This suggests they might be moving some of that cash into other investments. Their securities portfolio, which is how they invest their money besides loans, grew significantly. Available for sale securities jumped from $358 million to $547 million. That is a big increase, showing a strategic shift to diversify their holdings. Even though their deposits are growing, their net interest income, which is the core of a bank's earnings, has seen some ups and downs. For the 3 months ending the 30th of September 2025, net interest income was down about 10% compared to the same time last year. This is mainly because the interest they earned on deposits in other banks, like those held at the Federal Reserve, went down. This makes sense because interest rates have been dropping. However, for the 9 months of the year, their net interest income actually went up almost 15%. This difference between the quarterly and year-to-date performance is important. It seems they are benefiting from higher balances in their investment securities. But here is where things get really interesting. Their non-interest income, which is money they make from things other than loans and securities, took a huge hit for the 3 months ending September 2025. Their non-interest income dropped over 70%, and for the 9 months it was down almost 70% too. This is a pretty dramatic drop, and it is mostly due to their deposit placement services income. This revenue stream took a massive nosedive. Why, the report says it's because they are holding more of certain types of deposits on their balance sheet instead of placing them with other banks through a program called ICs. While this might help them manage their balance sheet better, it clearly impacted their fee income. On the expense side, their non-interest expenses went up 15% for the 9-month period. A big chunk of that increase comes from salaries and employee benefits, which grew by over 13%. This likely reflects the cost of growing the company and operating as a public entity. Insurance costs also shot up by over 150%. Which is a massive jump and probably tied to their new public company status and increased risks. When we look at profitability metrics, their return on average equity dropped from 25% to just under 13% for the 9-month period. Their return on average assets and return on average risk. Weighted assets also saw a dip. This suggests that while they are growing, their profit generation relative to their investments and assets has decreased. Within their loan portfolio, commercial real estate loans have decreased by over 8%. They are strategically reducing their exposure to this sector, especially non-owner occupied office loans, which have seen a nearly 50% drop. This is a smart move given the current trends in remote work and rising interest rates that are pressuring commercial property values. Their total securities portfolio has grown significantly, up over 26%. A large part of this growth is in US government treasuries, which is a very safe place for a bank to park its money. This shows them prioritizing safety and liquidity, which is crucial given the economic uncertainties and the nature of their unique client base. Their deposits are predominantly non-interest bearing, at about 69%. This is great for the bank as they are not paying interest on a large chunk of their funding. However, a significant portion of these deposits, over 60%, are uninsured by the FDIC. This means their clients have a lot of money with them that is not protected by federal insurance, which is a risk for both the bank and its clients. They are using a network called ICS to help manage this risk and their balance sheet by placing some deposits with other banks. On the capital front, Chainbridge Bancorp's bank subsidiary is in great shape. Their capital ratios are well above the required levels to be considered well capitalized. This strong capital position provides a good buffer against potential losses and shows financial strength. So, what is the takeaway here for Chainbridge Bancorp? Well, they're navigating a complex environment. Their core banking operations seem stable, and their commitment to safety and liquidity with a big chunk in government treasuries is evident. The significant drop in non-interest income, particularly from that deposit placement service, is a big story and indicates a strategic shift that's impacting short-term revenue. Their move to reduce exposure in commercial real estate is also a prudent step. However, the high level of uninsured deposits and the volatility linked to political organisation accounts are considerable risks. Their strong capital position is a significant strength that helps mitigate some of these risks. Overall, ChainBridge seems to be making sensible moves to manage risk and adapt to changing market conditions. But the reliance on political clients and the impact of interest rate fluctuations will continue to be critical factors to watch. Now, looking at these results more broadly, ChainBridge appears to be focusing on stability and managing risks in a fluctuating market. Their strong capital reserves are a major asset, but the drop in fee income and the inherent volatility of their client base are definitely points to monitor closely. The bank is doing well to stay well capitalized, which is a great indicator of their long-term health. Alright, that is our breakdown of ChainBridge Bancorp's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their bridge to better banking is solid, or could it use some reinforcement? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives that make sense of the corporate world. And hey, if you want to chat more about these kinds of filings and get direct access to our analysis and community, check out our Discord link in the description. Thanks for watching, see you next time.